Tesla beat earnings. Tesla beat revenue. Shares popped 4% in after hours. Then Elon Musk started walking investors through the Capex plan, and the pop gave back. By the end of the call, Musk himself was acknowledging that his stock was down $7 a share since his opening remarks began. This is the Tesla first quarter 2026 earnings call, and this is what Wall Street was trying to price in. Let's start with what Tesla actually reported. EPS came in at 41 cents, beating the 37 cents Wall Street had penciled in. Revenue landed at $22.4 billion, beating the $21.9 billion consensus. Gross margin was the star of the show, 21.1%, up 478 basis points year over year. On the bottom line, GAAP operating income was $900 million. Non-GAAP net income was $1.5 billion. Operating cash flow, a healthy $3.9 billion. Free cash flow, $1.4 billion. And the balance sheet stayed strong with $44.7 billion in cash. One spot that was not pretty, the energy business. Revenue in that segment was down 12% year over year to $2.41 billion, pressured by the rollback of solar subsidies. On the face of it, this was a clean beat. EPS ahead, revenue ahead, margins well ahead, and on paper, the initial 4% after-hours pop made sense. Analysts had spent the last 2 quarters flagging margin pressure as the single biggest overhang on Tesla's stock. A 478 basis point jump in gross margin is the kind of number that, in isolation, changes the story. But the call reminded investors that Tesla has not been a beats and misses stock for a long time. It is a forward guidance stock, an Elon Musk call color stock, and a capital allocation stock. And on those 3 dimensions, the tone of this call was very different. Here's where the pop faded. Tesla raised its 2026 capital expenditure guidance from $20 billion to $25 billion. That is a $5 billion increase, or 25% higher spending than Tesla had told investors to model 3 months ago. Musk framed it as substantially increasing investments across Optimus, FSD compute, Cybercab production, and the TerraFab partnership. Those are the bets that, in Musk's view, justify Tesla trading like an AI platform and not like a car company. But a 25% step up in Capex without a corresponding near-term revenue bump compresses free cash flow, pushes out profitability on those new businesses, and forces analysts to rework their models. That is what Wall Street was pricing in when the after-hours chart reversed. On the product side, Musk made a bold claim. Optimus will be Tesla's biggest product, bigger than vehicles, bigger than energy, bigger than FSD. The 3rd-generation Optimus is already functional internally, with a public demo targeted for the middle of 2026 and volume production out of Giga Texas by the summer of 2027. On Cybercab, Musk confirmed that production has started, a milestone the market had been waiting on for 2 years. The Semi, he said, is coming soon. The Tesla Roadster 2 will get its demo next month. These are real timelines, but they are also the timelines that justify the Capex raise. If Optimus volume slips or Cybercab ramps slowly, the $5 billion spending bump turns from growth investment into margin drag. The most important detail on this call was probably the FSD hardware roadmap, and it was not a clean message. Musk confirmed that Hardware 3 vehicles, the ones older Tesla owners were promised unsupervised full self-driving on, will not receive unsupervised FSD. Tesla is offering those customers a discounted AI4 hardware upgrade as the path forward. Then came the surprise. AI5 has been dropped from the vehicle roadmap. Tesla is pivoting to what Musk called a modified AI4 instead. Unsupervised FSD is, quote, probably not material this year, with customer availability, quote, probably in the 4th quarter. Robotaxi, he said, will be operational in roughly 12 states by year-end. That is a substantial walk back of the timeline that was being priced in just 6 months ago. On the semiconductor front, Musk laid out the TerraFab partnership with Intel. Tesla will be leveraging Intel's 14A process for next-generation AI silicon. And here's the twist. SpaceX, Musk's other company, will be handling the initial scaled phase of TerraFab production before it transitions fully to Tesla. That is an unusual structure, and it is the kind of related party arrangement that will get scrutinized in Tesla's next proxy filing. It also tells you something about how Musk is thinking about Tesla's compute build-out. The Capex raise is not just about Optimus factories, it is about owning the silicon stack. So where does this leave the stock? The bull case is that this was a beat, margins inflected, and the Capex raise is the price of being first to Optimus, Cybercab, and unsupervised FSD. The bear case is that Musk walked back the FSD timeline, dropped an entire chip generation from the vehicle roadmap, raised Capex 25%, and told investors the energy business was down double digits. Somewhere between those two views is the reality that Tesla is still a story stock, and the story is getting more expensive to fund. Musk's own acknowledgement mid-call that the stock was dropping while he talked said it better than any analyst note could. This is the money mind, not financial advice. Do your own research.